Hi, welcome to Neppy Invest. Welcome to my final video of the series, ASX Stocks to Watch in 2021. I've been doing themes in this video series, and today's theme is small caps. And I love small caps. A lot of people watching this video probably love small caps too. And this is a very exciting month. So finally, tomorrow, so I'm recording this on the 3rd of January, finally we get the first trading day of 2021, Monday the 4th of January. It's a very exciting month. I love this time of year because January is Appendix 4C season. So we start to see some small caps releasing their Appendix 4Cs, their quarterly cash flow reports, as we head further into January. And I'm always excited to read how these companies are doing. So before I get into the main crux of the video, the whole point of me doing these videos, these ASX stocks to watch, or any sort of video where I'm talking about stocks to buy, stocks to watch, is to give or share ideas. So it's very powerful to share ideas. So the whole point of this is I give you some ideas. It's not advice at all. So any companies I will be showing you today, it's not advice for you to buy. It's just giving you an idea that potentially you can do some more research on. And if you do enough research and you like what the company's doing and it fits into your own investing style or strategy, then maybe you can do, buy that company, do an acquisition of their shares. So it's all up to you. I'm not going to tell you whether to buy or sell, that sort of thing. It's just to give you ideas. So let's get stuck into some of these ideas. So not all of these companies I will be following or even think about buying, but that just doesn't mean you don't have to do that. So the first company is Cirrus Networks. So this is sort of an IT managed service company, and they've been around for a few years. They were actually a backdoor listing about 5 or 6 years ago. And you can see the revenue has increased from $19.5 million in 2016 to $95 million in 2020. But even though we've seen really good increases in the revenue, in fact, the last 4 years, it's been compounding at 49% per year, although that is slowing down. So even though we are seeing good increase in revenue, the market cap is still only $28 million and operating cash flow $3 million, which also suggests they probably have quite low margins. So I just included the margins there. Gross margins of 34%, operating margins of 5%. So I did some research on a company called Dicker Data. That was a few years ago. And they have they have lower margins than this. In fact, when I did the research on Dicker Data, they had revenue of over $1 billion, but were operating cash flow and profit was only a few $1,000,000 when I did the research. So that was even lower margins. But since I did the research on Dicker Data, they've really improved the margins a little bit, but they just expand on the revenues, and that's all gone on the bottom dollar. And they now have a market cap of something like $1.2 billion, which is far removed from Cirrus Networks. So even though I'm sort of trying to compare Cirrus to Dicker Data, I don't think you can really do that at this point in time. My only concern does look like the revenue has slowed down in growth the last few years. So it's gone from 88 million last year to 95 million in 2020. So that's a lower growth and only 11.8% growth over the past 2 years. And the chart here just shows you that there is a bit of an uptrend developing, but it's a very slow uptrend. Nothing too exciting then. So what I'd be waiting for with Cirrus Networks, and this is just my own opinion, is I'll just be waiting for maybe some further financial good news, increasing margins. One of their services, managed services, is cloud niched, and they do have margins in that of between 35 and 40%, if I remember correctly. Maybe that's gross margins. And revenue of 11.8 million, increasing by $2 million over the previous year. So that's where they have the highest margins. That's one thing they do have in that segment or that sector of their business. So anyway, it is an interesting company just based off the fact that market cap's so low. And if they can start increasing that revenue, increasing their margins, this company could really take off, especially their share price. Vysarn Limited, only been on the ASX a short period of time, I believe. And the main reason I started following this company was they did an acquisition about 18 months ago, some sort of drilling thing. Now, they are hydrogeological drilling and dewatering service company. Now, the dewatering services was the interesting part for me because I hadn't really thought about dewatering or the art of dewatering, but a little bit of research showed that something like 60% of the resources in the Pilbara are under the water table, which means if they're under the water table, you have to keep pumping the water out. And Vysarn provides that service. So you can see the chart also, another reason why I was attracted to this company. Really good uptrend over the past, say, 4 or 5 months since, say, late July, August. And the share price has gone from around about 5.5 cents all the way up to 12 cents. So good uptrend developing over the last 5 or 6 months. And whether they continue that trend waits to be seen. But they are a profitable company, operating cash flow positive. So that's actually good news. And it is a company I am actually personally following. Vonex, this is a telco. Now, this has a market cap of... One of the reasons I started really, or doing a little bit of research on this company is the second line on the right there. So market cap of 44 million, but they had annualized recurring revenue of 16.7 million, which was up 84% on the previous year. Now, I saw that and I went, whoa, that is really high, both the annual recurring revenue and the percentage increase with that sort of market cap, 44 million. Another company I'm going to be talking about in the next few slides is called Dubber. They have an annualized recurring revenue very similar to this, a very similar growth rate to this, but their market cap is over 400 million, so 10 times more than Vonex. So something's up here, and I was immediately drawn to this company based off that one line, annualized recurring revenue and the growth rate there. The chart looks good too, especially if you look at around about the mid-August, early August to mid-August. We had a big up day. The share price went from about 11 cents to 16 cents. That was the entry point. That was a good giveaway, especially on large volume. There's something positive with the company. And we've just seen that trend going upwards since then. Now, let's talk about this analyzed recurring revenue. So I just saw that and went, whoa, that's a really big increase. And the percentage or the growth rate was really high. And there is a reason behind it, and it's not as exciting as I wished it was. It was all because of an acquisition. So as soon as they bought this company, they just put that to the bottom line. And so the annualized recurring revenue went from 9.22 million in December 2019 to 15.5 million in March 20. If you take out that acquisition, the growth rate in annualized recurring revenue is not that strong at all. So I wish they would show us the organic growth rate in ARR, and that would give us a better idea how they're growing. But it's not much. You can just see between December 2018 and December 2019, it went from 8.13 million to 9.22 million. So not that strong of growth at all. And that's the reason why the market cap's so low, even though the annualized recurring revenue is quite high at 16.4 million. Next company is Metals X. So this is a mining company in production. And the main thing that drew me to this is the chart. So technical reason I was drawn to this. And the first chart I've got here, so I'm going to show you two charts. The first one here is a 3-year chart. And you can see the share price going back to January 2018, got as high as $1.20. And ever since then, the share price has just been trickling downwards. And if you've been a shareholder during that time, you would have seen your wealth absolutely destroyed. And this is a really good reason why you never hold a company when it's in a downtrend, because you never know when that downtrend is going to stop. And I decided to just look at the revenue and operating cash flow this company has had since 2014. And you can see in 2016, they had revenue of 351 million. And that's just been going down ever since. And in the previous financial year, the revenue was 143 million. Operating cash flow was as high as 83 million in 2015, and that's been going down as well. In fact, they're negative, or operating cash flow negative, in the last 2 years. So that's the reason why this company is going backwards. But this is the daily chart for the past year, and we can definitely see something happening in the past month and a half. The share price has entered into an uptrend, and a quite quick uptrend. In fact, I've been interested in buying this company a couple of times at 10 cents and then at 12 cents. I haven't really bit the bullets just because of their financial status, and there's a possibility here that the market is ahead of the company in releasing some good news in terms of their finances. So can you see market cap 127 million, operating cash flow negative 20 and revenue 143 million. So they would have to improve those financials a fair bit. And the market may be hinting at that. We'll wait and see. So they do mine tin, copper, and nickel, and some of those copper and nickel I'm actually quite bullish on. I haven't really thought about tin, but they are sort of mining in some bullish metals there. So it'd be interesting to see what happens come February when they release, actually come later in this month when they release their quarterly activities report, and then next month when they release their half yearly or yearly, depending on what calendar they are going by. So the next company I'm going to look at is Catapult. So this is not a device to put me in and fling me towards your enemy's tower wall or something. I don't think I would make that much of an impact. Instead, it is sort of the best way to put it is an improving sporting performance tech company. And so they have a market cap of 370 million. Some good revenue and operating cash flow in the past year, 101, and operating cash flow positive to the tune of 22 million, which is very interesting indeed. So with this sort of company, what I'm looking for is really good revenue growth. And if the share price growth is not matching that, I become even more excited. And in Catapult, we are seeing those things. Good revenue growth over the last 5 years at 55%, although that growth has slowed down in the past year, which more than likely is because of COVID-19. So I'm very interested to see how Catapult is doing this year. So we get a bit of a clue in February with the half-yearly results being released, or if then maybe they do yearly results in February. But the share price growth has been much slower than the revenue growth, which is showing that there is potential for share price growth to match that revenue growth. So share price growth, if you go back to June of this year, so that the share price was $1.13, and the share price growth has only been 2.27 based off the share price of $1.13. If we put in the share price of $1.86 into the growth of the share price, we only see share price growing at 13% per year, which is still much lower than the revenue growth. So there's a lot of room for the share price to grow if the company can maintain revenue growth moving forward. And that's the main reason I'm a little bit interested in this company, just based off that little thing, that share price growth isn't being matched or isn't matching revenue growth. And you can see on the chart on the left, the company's shares have been quite volatile through its life. Have a look at the long-term chart. You'll see that volatility. And you can see in the past year, share price has gone from $2.20 to 50 cents, back to $2.50, and now has just drifted lower to about $1.85 or $1.86. So I am interested in this company, and it's definitely on my watch list. Next company is Dubber. Best way to describe this company is voice data or call recording as a service. So they are as a service company, which means they will usually provide annualized recurring revenue. And for this company, it is $18 million and up 77%. If you remember, Vonex, they had very similar numbers than that, but their market cap was much lower. So this is real growth. And on the right-hand side, I've just provided their revenue and share price on a yearly basis from 2017. You can see revenue has gone from 510,000 all the way up to 9.65 million. So that's fairly significant growth over a 3-year period. In fact, it's 166% per year. We won't see that sort of growth moving forward. But if they can maintain revenue growth of, say, 50 to 75% per year, just like annualized recurring revenue is doing at the moment, we're going to see a much higher share price moving forward, because share price is increasing by 72% per year. So it's trying to match the revenue growth, what we're seeing now, which is around 77%. But if they can maintain that revenue growth, there's no reason to suggest that the Dubber share price won't increase from here on in. Now, that share price growth is based off the share price in June, which was $1.13. Since then, the share price has risen to $1.67. So even if you put $1.67 into the share price growth, it's still only growing at 90% per year. So still a lot of room to grow for Dubber if revenue growth can be maintained. There's no reason to suggest it won't be. Last company I'm going to be looking at is Medical Developments International. If you don't know what this company do, they provide Penthrox, which is that green whistle, which relieves pain. So you might go into the ambulance and they'll give you a little green whistle to take a breath. I think it takes 6 or 7 breaths before it relieves your pain. It doesn't take away your pain fully, just relieves your pain. So market cap 465, only revenue of 23 million, but I think their margins will be quite strong, and they are cash flow positive to the small tune of $170,000. Now, I've also provided the revenue and share price growth over the past 6 years or 2 years, what I got there. You can see the revenue growth has been quite good at between about 13 and 15% over the last 6 years or so. Share price growth is a little bit greater than the revenue growth. I think the main reason behind that is I think the market has seen the potential of this company and it's got a little bit maybe too excited at times. But I think that excitement has waned over the past few years. You can see share price growth over the past 2 years is only 9.7%, while we're maintaining, or the company's maintaining, that revenue growth of 14%. So there is potential, or there is possibilities of entering into MVP or medical developments at this point in time, because it does look like just the chart on the left that this could be entering into potential start of an uptrend. So this is another company that I've just put onto my watch list. If they produce a very positive announcement in the next, say, few months, or if their half yearly is quite interesting or quite good, that could be the impetus to buy into this company. So that's all I've got on these ASX stocks to watch in 2021, small cap style. Hope you've enjoyed this video. If you have any questions, leave it in the comment section. Otherwise, happy trading, happy investing for 2021. And again, I'm not a financial advisor. If you do need to seek financial advice, make sure you seek out someone who is qualified and can help to your own particular circumstances.